Hey everyone, Richard Norris here, and in today's video, I'm going to show you how you can drive your dream car literally for free by using property. So, one of the key lessons that I learned early on in my journey was all about financial literacy. And to be honest, most people aren't financially literate, right? And that's one of the biggest things that was missed out of the education system. And one of my passions is trying to help instill financial literacy into everyday people like myself. And I went on a mission for a long time learning financial literacy. And one of the things that I've learned is that the number one rule is that your assets must pay for your liabilities. You should not use earned income to fund liabilities and luxuries. And those luxuries could be anything from even the home that you live in is actually a liability, right? Should not use earned income to pay for your mortgage. You should not earn income to pay for your dream car. You should not use earned income to fund your holidays and things like that. You should invest that seed capital, and then off of the seed capital, off of the asset that pays you every month, you can then use that cash flow to fund the liabilities. So this video is based on that premise. So if there's anything that you take away from today's video, take that. Assets must pay for liabilities. So how do we buy our dream car for free using property? Well, let's say that you've got £100,000. And if you're somebody watching this video and you don't have £100,000, don't worry. I'm going to tell you at the end of the video what to do, okay? And allude to how to make your first £100,000, okay? Because I have another video coming out, which you can watch. But let's just assume that you've got £100,000, right? Just for the purpose of this video and showing you how this works, right? So you've got £100,000 in cash. Now, let's say that the dream car that you want to buy is a Range Rover. And I've used the Range Rover as an example in this video because it's a supercar. I guess it's the first level of supercar, right? Because you've got the Lamborghini Urus, the Bentley Bentayga, and all of those things are a bit more expensive. So what I want to do is just talk about Range Rover, make it kind of a luxury car, but kind of keep it realistic at the same time. So that's why I chose a Range Rover. For those of you who are thinking, why, what made Rich choose a Range Rover? Range Rover is a car that a lot of people would aspire to have, and it's a lovely car, right? But the Range Rover costs £83,620. That's today's retail price of a Range Rover. Now, if you had £100,000, of course, you could go and buy that car for cash. And you could buy it, and you'd have about 17,000, 16,500 left over of cash in bank, and you'd have your brand new shiny Range Rover. But the problem is, you've now spent £83,000 of cash into a liability, and the car's not making you any money every month. In fact, it's costing you money every month because you've got to put fuel in the vehicle, maintenance, MOT, servicing, all of those things, right? And any other unknowns that might go wrong with the car. But the biggest problem with buying a car for cash like that is that the car is obviously going to depreciate the moment that you take it off the forecourt, right? So the moment that you drive it away, your car's going to depreciate. So within 2, 3, 4, 5 years' time, the thing that you paid £83,620 for is now only worth £40,000 potentially, right? So you've just lost £43,000 in that transaction by buying a car and all of the money that you've paid on servicing the car whilst you've been enjoying the luxury of the supercar. But there's a much better way. And you can actually drive it for free and be paid to drive the car. That's right, be paid to get the same car if you just think about things in a different way through financial literacy. So if I had £100,000 of cash and I wanted to buy my dream car, what would I do and what do I do? Well, the very first thing is I wouldn't buy a car in cash. Whenever I buy a car, I buy it on a PCP, which is called a personal contract purchase, right? And effectively, I'm going to bring up a statement here so that you can see. I went on the online calculator today for the finance of the Range Rover, so I got accurate figures for you for the purpose of this video. So what you can do is you can put down a £5,000 deposit, which doesn't have to be your cash actually. They call it a finance deposit allowance. Now, I'm not sure whether that finance deposit allowance comes from Range Rover Direct and is an incentive for you to do the deal. I believe that it is. So for the purpose of this video, we're going to run with that, or whether it's your cash. Either way, the same principles apply. So this £5,000 deposit contribution goes in. We're assuming Range Rover is given as incentive. They're going to knock that off the purchase price, and therefore the remaining balance that we need to fund on the PCP agreement is £78,620, okay? Now, if you look at the statement here, the £78,620 Range Rover that you've just bought, drive it away, you take out the payments over 49 months, and you're basically leasing the car from them to drive your dream car. Now, the monthly payments are £1,063.05 per month. That's what it works out to, and it's assumed on an allowance of 12,000 miles a year, which is probably average for most people, okay? Now, what I would do is I would look to say, okay, what properties or property can I invest in with my £100,000 capital where that £100,000 is going to grow It's going to get bigger over the years, and it's going to pay me every month to fund the payments for my Range Rover. So we've got to find a way of investing £100,000, because that's the seed capital that we've got, to fund our £1,063.05 per month of payments every month on the car. So I'm going to give you a couple of deals that sit in my portfolio. I brought some of these deals back in 2017, but I just want to explain to you the purpose and the rationale of how to do this, just so I wanted to bring up real life examples and tangible examples for the purpose of this video. So one of the things that you can do if you're starting out is converting like a 3-bed property into like a 5-bedroom HMO, where you basically have 5 people living in one property, sharing communal facilities and living spaces, okay? And all of the tenants pay you individually. Now, if we had £100,000, the very first thing I'd do, I'm going to give you an example of one of the deals that sits in my portfolio, the exact numbers when I bought it, and this is in Canada Street over in Stockport, okay, 3-bed to 5-bed HMO conversion. Now, I purchased this property for £140,000, okay? I put down a 25% deposit contribution, which basically means I put down £35,000 of cash. And then I took out a mortgage for 75% loan to value at £105,000, okay? The stamp duty and legals on this particular transaction came to £6,000, okay? And the refurbishment cost was £40,000, okay? And the furniture and white goods to furnish the place was £5,400. So if we add up all of those numbers, the total cash that was invested into this one deal out of your £100,000 would be £86,400, which leaves you £14,600 back in your bank account, okay? So that's the investment that's required to go into buying this HMO property. Now, what you do is typically what we call a buy, refurbish, refinance process. And if you're not familiar with buy, refurbishment, refinance process, again, go and check out some videos on my channel after watching this video, because I talk about buy, refurbishment, refinance models, and I break down how the numbers work. And I'm not going to go into the granular detail in this video, because I just want to explain to you from a high level how we can basically buy our dream car for free using property and the principles of investing your seed capital so that your assets pay for your liabilities and you have a nice balance sheet and you can live the life that you want. So one of the things we do when we buy a property and we add value to it is we refinance the asset as quickly as we can. Now, at the time of doing this, I had to wait 6 months. In today's market, we can actually refinance quicker. As long as we've added value, we can actually refinance immediately, which is an excellent thing and gives us a great opportunity to move faster as a property investor. So I went back to the bank and I said, look, I bought this property for 140. I spent 40,000 doing it up, changed it into a 5-bed HMO, put an ensuite in and stuff, and I want to come and get it revalued. They came out and they revalued the property at £210,000. So what did I do then? Well, what you do when you get the property revalued is you take out the mortgage of 75% against the 210. So I raised the mortgage value to 157,500, which is 75% of the 210. I paid back the original mortgage of 105,000. Remember, on day one we bought it for 140. You put 35 in, the mortgage was 105. So we get the 157,500 pounds. We pay back the 105,000, which gives us 52,500 pounds back into our bank account. On top of the 14,600 that was left in the bank account, we have 67,100 pounds of cash left in our bank account now out of the original 100,000 we started with, and we have a 5-bedroom HMO property that's been fully refurbished that we can now rent out and provide income. Now, this is the important part. What does the income look like? Well, the first thing to note is on this particular property, we've also gained £52,500 in equity, right? Because the property is now worth 210,000. The outstanding mortgage on the property that I've taken is 157,500. So the equity position, the difference between those two numbers, is £52,500 of equity in that property. Now, this property rents for £2,250 per month, which is £450 per month on average per room across the 5 rooms in Stockport. The management fee is 12% of the £2,250. I pay a management agent to do that, to look after the property, £270 per month, and then I allow for my monthly operating expenses at 25%. That gives me a contingency for any kind of maintenance that needs to be done, but it also allows for gas, water, electric, council tax, because I pay the utility bills as the landlord when I'm renting out to professionals in this particular area. So we take 25% of the gross rental income of 2,250. We end up with a figure of £562.50 per month that we need to cover for utilities and all the things I spoke about. And then we have our mortgage. Now, I've ran the mortgage at 5%. On this particular property, my mortgage isn't 5%. I actually fixed this in, is currently fixed in at 3.79%, but we'll run today's market. So the mortgage is at 5%. So we basically are paying 157,500 times the 5% interest divided by 12 gives our monthly mortgage payments, and that comes to £656.25. Now, therefore, if you kind of take your rent and you minus off all of those disbursements. So you take your rent, £2,250 per month, you minus off your management fee of £270, you minus off your monthly operating expenses at £562.50, and your mortgage at £656.25 per month, you end up with a gross profit per month of £761.25 per month and £67,100 of cash in your bank account. So we've now got one asset, £67,100 in the bank, and one asset making us £761.25. But of course, there's a little bit of a shortfall because remember, we need £1,063 to cover the payments on the car. So we're a little bit short. We've got £67,100 that we can go and reinvest and buy a second property. So then if you went to buy a second property, and one of the things that I do, and one of the things I teach my clients to do in propertyconsulting.io, we help people to grow and start portfolios, is I teach them to buy property using government-backed schemes, right? Like social housing. And one of the providers that I use, because I invest in the Northwest, one of the providers that I use is a company called Serco. And I happen to have some properties in the Northwest and some of them with Serco. The one I'm talking about is in Warrington. And effectively, you could do a similar sort of thing. So I'm going to give you one that sits in my portfolio. So the current value of this property, okay, and it's also good to note that this is a 5-bed HMO. Still the same strategy, still an HMO strategy. I like HMOs because you can see I can get my cash flow between £750 to about £1,200 per month if I'm doing a 5 or 6-bed HMO. That will be the rough range. And for every £30,000 to £40,000 of capital that I leave in a deal, I want to get £1,000 to £1,200 back on average. Okay, that's just the metrics that I work to. So this particular property, it's a 5-bed HMO. Let's just say you bought it, it's readily functioning. You don't need to do too much to it. You're just going to buy it. So it's £190,000 purchase price. Therefore, the deposit that you put in is 25% of the 190. Okay, which gives you £47,500. That's your deposit contribution, and at the same time, that's your equity position. And then you take out a mortgage of £142,500, which is the difference between the 190 that you bought it for and the 47.5 that you put in. Gives you a balance of 142.5 at 75% loan to value with your mortgage. Now, the stamp duty, land tax, and the legals on this specific property would be £7,700. Okay, and the furniture and minor refurbishment. So when you go and do a Serco property, you have to put down like a little bit of a different spec. One of the things that they ask for is like lino in the kitchen areas, for example, and they have a specific furniture packs that they want you to purchase, which is steel bed frames and stuff. So it's very fit for purpose. So it doesn't cost a lot of money if the property's in a good state to basically go and transform this and give it to Serco in the condition that they want. So I've allowed £10,000 in my calculations here for the purpose of this video. So if we add that up, the £47,500 deposit that we need to put in, the stamp duty, legals at £7,700, and the £10,000 refurbishment, the total cash injected needs to be £65,200. And remember, we had £67,100 in the bank, so we can do this deal. So this is the second property now. So we've now purchased this second property. This property happens to rent for £1,500 a month across the 5 rooms. And the only thing that I've got to pay is my mortgage. And the only reason I've got to pay my mortgage is because the management I don't have to worry about. I've got a 5-year fixed lease with Serco. They deal with all of the management, and they deal with basically 95% of everything, right? They deal with the utility bills, they deal with any minor refurbishments. It's only things like structurally, like that we're responsible for as the landlord, right? So we don't really need any monthly operating expenses in here because there aren't any really. There aren't any. So we just have the rent of £1,500. We have the mortgage that comes off at 5%. So the mortgage, remember, is £142,500. That's the mortgage balance on the property. So at 5% interest broken down into monthly payments, our mortgage will cost us £593.75 per month. And if we take the rent of £1,500 minus off the £593.75 that we need to pay on our mortgage, then our gross profit is £906.25. So if we add up that now, we've got 2 properties, and we've kind of spent £100,000, but we've got 2 properties with £100,000 investment. Property number 1 makes £761.25 per month. Property 2 makes us £906.25 per month. If we add those 2 numbers together, we're now getting a gross profit per month from 2 assets of £1,667.50 per month. Now that's enough. That cash flow is going to do it. Perfect. We take the £1,667.50 a month profit. We minus off our payments, which is £1,063.05 for the car, and we're left over with a profit of £604.45 per month to drive the Range Rover. And we've still got our seed capital, £100,000, sat in assets growing. It's a much better way to do it, right? Now, you also have to remember that what happens if we get capital appreciation on these properties, because you will get capital appreciation. And on average, if we just go for a general rule of thumb, on average, everybody says property doubles every 10 years. May or may not be wholly true, but it's partially true. For the purpose of this video, let's just roll with that because it seems like a sensible general kind of thing to talk about. So let's assume that both of these properties over the next 10 years doubled in value. So property number one is worth £210,000 after refinance. So let's assume that that doubles in value. That property is now worth £420,000. Property number two we purchased for £190,000. Assuming that doubles in value, it's now worth £380,000. So if we take the £420,000 appreciation value of property number one plus the appreciation value of property number two of £380,000, we add those two together, we get a combined total across the two properties in total value of £800,000 worth of property. Now remember, when we initially bought these properties, and even after refinancing property number one, we had a mortgage liability of £157,500 on property number one and a mortgage liability of £142,500 on property number two. That means that the total liabilities on those two properties is only £300,000. So assuming that we didn't refinance the properties, we left the mortgages as they are over the 10 years and just collected the cash flow, we've now got property portfolio worth £800,000 with a mortgage liability of £300,000, which gives us £500,000 of equity in the property, plus all the cash flow that we've received for the last 10 years, and we've still been driving the same car as if we were to buy it with £100,000 of cash. Crazy, right? This is what financial literacy can do for you. So let's just really clarify this then. So if you decided, and you wouldn't do this, but let's say you decided to sell both of those properties and cash in, where you get £500,000 of cash out from the sale, minus your taxes, minus your sales and legals, maybe you're left with £450,000, let's say, plus the 7,000-ish to 7,200, it was about 600 a month profit that we were making, wasn't it? So time we paid the car payments off. So let's say £600 a month times 12, 7,200 a year, times that by 10, we've got 72,000 a year in net profit from cash flow from the assets from renting them out, plus the £450,000 from the sale. Add those two numbers together, we end up with the value of £522,000. In that scenario, I mean, we're £522,000 better off driving the same car that we would if we had purchased for £100,000 cash and have all that depreciation over the 10 years and it's now only worth 20. We're like £500,000 better off just by changing the way we use our money. And that truly is the power of financial literacy and what I want to share with you today. It's exactly what myself do, exactly what my clients do as well. And honestly, I know it sounds stupid when I talk about it in the video, but there are honestly people who take the £100,000 and buy cars for cash. They do that. Or out of the 100,000, use 50,000 to buy their car for cash because they don't want a monthly payment on it. But they're not understanding financial literacy. They see it as bad debt, but you can turn it into good debt if you use the money wisely, like I've showed you in the video, to get your assets paying for your liabilities. Number one principle that you need to take away. So I hope you enjoyed this video, and if you did, please go ahead and click the like button. I'd really appreciate it. If you're new to my channel, please make sure you subscribe and also hit that bell notification icon so that you can be notified when we release new content. Thank you so much for listening. You've been great. I'll see you in the next one.